Fed Williams came to the rescue on last Friday, managed to trigger a relief bounce on the major US stock indices. The US dollar continues to trade in the tight range and gold remains lackluster. Very good morning to all and welcome to a brand new trading week. I'm Kelvin here. Very good morning. Welcome to today's Daily Dose of Market Insights. Today will be Monday, the 24th of November 2025. So as usual, before we kickstart our gist of the Daily Dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so let us get started. Firstly, let's have a quick recap what has taken shape over last Friday in terms of the news flow, relevant news for our Z, economic data release, and their impact on the broad-based cross-asset classes. So on last Friday, we do have a kind of a comforting remark in a way from one of the key US Federal Reserve official, which is nonetheless is the New York Fed president, which has a much greater say or say greater influence in the decision-making process of the FOMC committee. On top of that, we do have the Fed chairman and the vice chairman, and the next up in ranking will be the New York Federal Reserve President John Williams. So John Williams, he did a dovish. Okay, give me a minute. Let me put it in writing. Right. So let me expand it over here so that you guys can have a better view. All right. So what he did over here is that odds of another interest rate cut jump on Friday after New York Fed President John Williams signaled that he could support a cut when the central bank meets in December. So he did mention that I see room for further adjustment in the near term to the target range for the Federal Reserve funds to move the stance of policy closer to the range of neutral, Williams said in a speech in Chile over here. So though he see rooms to cut, Williams said that he believes that tariffs have temporarily stalled progress towards the Fed 2% inflation goal over here. And Williams' comments carry added weight because he's the vice chairman of the FOMC committee as well, and one of what's unofficially known as the tricolor of the group of leaders at the Fed, including Fed Chair Jerome Powell, Vice Chair Philip Jefferson. So his weight triggered a we call it a increase in the dovish rate cut bets as compiled by the CME Fed Watch tool based on the latest price action of Fed Funds futures traders. So if you look at the CME Fed Watch tool on Friday, the probability jumped up to 69%, back above 50% again. So at the start of this week, we do have the odds of the Fed rate cut has been greatly reduced to below 50%, all right, at the start of the week, and also ranging before prior to Fed Williams' dovish remark on Friday, it was also hovering around the 30% to 40% probability mark. So with his speech, the Fed funds, we call it futures traders, has increased the rate cut probability back above 50%. To be precise, it's now hovering at this 69.4% as we are speaking, to bring the Fed funds rate down by another 25 basis point to 3.5% to 3.75% on the 10th of December 2025 FOMC meeting from the current target rate of 3.75% to 4%. And that being said, that allowed the liquidity narrative to come back into the US stock market and causes the US stock market to stage a relief rebound after Monday to Thursday sell off. All right, so on Friday, the SPX are up by 0.98%, almost 1%. The Nasdaq 100 up 0.8%. The Dow Jones and the Russell 2000 outperformed with gains of 1.10% and 2.8% respectively. So, but however, if you look at the heat map of the S&P 500, we see the heavyweight NVIDIA, which is the largest weightage market cap stock in the S&P and Nasdaq 100, continues to weigh negatively on the market. So NVIDIA failed to actually caught a bullish bid on Friday and closed negative, down almost 1%. And also the rest of other larger cap semiconductor related stocks like Broadcom and AMD also down by 1.9% and 1.09% respectively. So the net overall impact over here is that Nvidia may potentially continues to weigh down on the S&P 500 and the Nasdaq 100, and they may create a negative feedback loop into other uh, semiconductor stocks in the US as well, and potentially that could be we call it negative, potentially a negative impact on the S&P 500 and the Nasdaq 100 and somehow into the broader US stock market, given the fact that in the last 3 years, the broad-based rally in the US stock market has been pretty much highly dependent on the semiconductor stocks, especially those stocks that has a higher weightage like Nvidia, driving on this AI optimism productivity team play. Right, so that's for the US stock market. And because of that rise in the probability in the CME Fed Watch 2, indicating now there's a higher chance of 69% of a 25 basis point cut in the FOM in the 10th of December 2025 FOMC meeting. That causes the that causes the US 2-year Treasury yield to trade back down below the 50-day moving average. So we know that the 2-year US Treasury yield has been a very sensitive move in, we call it high sensitivity to the rate cut odds or rate cut heights by the FOMC monetary policy stances. So given that the rate cut bets has increased as indicated by the CME Fed Watch 2, the 2-year Treasury yield, the US 2-year Treasury has started to inch back down below the 50-day moving average and traded down towards the lowest level in the last 5 days, back down below, now trading at 3.5% as we are speaking, based on last Friday prices over here. So with that, that causes the US dollar to be lackluster over here. So on last Friday, the US dollar gave way over here at this point in time. So with the exception of the dollar Swiss, which is still up positively at 1.6% as we are speaking right now. So this is a 5-day rolling performance. So if you look at the 1-day rolling performance based on the last 24 hours, the dollar has started to be trading in a lackluster fashion. All right, it's tend to just to go congested in a very tight sideways range. And if you look at the US dollar index, which I tend to use it as a gauge of general US dollar strength and weakness over here. So the US dollar index continues to see a series of we call it a spinning top candlestick pattern in the last 2 sessions on Friday and as well as on Thursday. So Thursday it formed a spinning top, and on Friday it also formed a spinning top candlestick pattern as well, as it continues to hover below a key medium-term resistance at 100.54 level over here, which is this potentially upper limit of this complex sideways range configuration that the price action of the US dollar index, this is the daily chart, that has been congested since the low of 2nd of July. But what's interesting over here is that price action still managed to be held above the 200-day moving average, where the daily chart of the US dollar index managed to surpass it on last Wednesday. So in order to see much more substantial dollar weakness, at least in the near term, the price action of the US dollar index got to reintegrate back below the 200-day moving average that is acting as a near-term support level at 99.87, and it's coming very close to the 20-day moving average as well. All right, so for now, in the shorter term, we may see a bit of a mixed intraday price reaction among the major US dollar pair, as the US dollar index remains kept below a key medium-term resistance level at 100.54, and price action starts to show hesitant by the bulls by the two spinning top daily candlestick pattern on last Thursday and on last Friday. But however, the price action still remains supported in the near term because it still didn't have a daily close or a daily close that is above the key 200-day moving average that is now acting as a near-term support level at 99.87, and it since has a daily close above it since the bullish breakout on last Wednesday, 19th of November. So do expect a bit of short-term mixed performance among the major US dollar pair due to such we call it conflicting technical elements that I share with you guys on the US dollar index on its higher time frame, which is the daily chart over here. All right. Now, other pertaining news flow over here is last Friday we do have the release of the S&P Global. Is a company that produce this manufacturing and services PMI across the globe over here. So even though the S&P Global is not as widely watched for US tends to watch the ISM PMI data, but it still do have a bit of way or market sentiment over here. So on last Friday, let me share you guys the chart on last week over here, the previous week. Okay, so on last Friday, the preliminary flash data out from the S&P Global company that compile this manufacturing and services PMI across the globe for all countries. For the US one, the services in the services side of the story came in better than expected. So on Friday, very quickly, let me share. Let me pull up. Yeah, this is the one over here. Yes, all right. So services will be much more primary important in the US economy, given that close to 70% or 3/4 of their GDP growth dependent on services activity. So the S&P Global Services PMI preliminary data for the month of November for the US came in better than expected slightly, so still hovering above the expansionary level of above 50. So market is expecting 54.6. It came in at 55, also above the previous month October print of 54.8. So services activity in the US continues to remain rather robust. I would say it's still expanding rather than contracting. All right, so that also give a bit of what I call uplift in the major US stock indices on last Friday as well. All right, so over the weekend, Japan officially approved a 135 billion stimulus to mitigate inflation pain. So this 135 billion additional stimulus is much more than the previous budget that was actually being approved in the previous administration. So that also causes the Nikkei 225 futures to remain hovering above our key near-term support level as well. So later I'll touch on more about the Nikkei 225 short-term intraday technical outlook. So that sum up the first segment of the daily dose. So let us now proceed to the second segment, which is the intraday technical outlook chart on all the broad-based cross-asset classes. So before that, let me expand my screen so that you guys could have a better view of the charts. All right. Okay, let me expand my screen. Okay, so give me a couple of seconds just to make sure that everything is okay. All right, so all things are good. All right, excellent. So let me start with the FX market. All right, so yes, okay. So let me start with the euro dollar. All right, so the euro dollar continues to trade below our this 20-day moving average that is sloping downwards. Price action came down, inched down on last Friday, where we have a bearish bias as well, hit our first support level at 114.95 before trading sideways in the entire US session. So with that, we will still maintain that bearish bias with two key resistance level to watch on the euro dollar as it's fast approach a key near-term support level at 114.75, which is the minor swing low of 14th of November and minor swing low of 4th of November and 5th of November. So I'll be using a slightly adjusted Titan short-term pivotal resistance for today on the euro dollar, which is at 115.50 over here. So using 115.50 as my short-term adjusted pivotal resistance level, near term another resistance level to watch will be at 115.24 over here, 115.24, maximum 115.50, which that will be my adjusted short-term pivotal resistance level. Euro dollar still maintaining that bearish bias for another potential dip down, potentially to test the key near-term support level at 114.75 below 114.95. However, if we start to see a bullish breakout above 115.50, so then potentially that would invalidate today's bearish bias on the euro dollar to see a recovery towards 115.90 116.15 next. Right, so that's for the euro dollar. Next up will be the sterling pound over here. So the sterling pound continues to remains below the 20-day moving average. That's acting as an intermediate resistance. We saw confluence with our pivotal resistance level as well at 131.40. So last Friday it hit our first near-term support level at 130.40. All right, around 130.40 level. 130.43 to be precise. All right, so hit down at 133.43 before rebounding during the US session, and it just traded sideways thereafter. So still using 131.40 as my key medium-term pivotal resistance level. Still maintain that bearish bias for deep down towards 130.43. A breakdown below it exposes the key near-term support zone at 130.15, 1.29 90 next. Only a bullish breakout above 131.40 that would invalidate today's bearish bias to see a squeeze up to retest previous week Friday swing high at 131.95 slash 32.15. That is 14th of November minor swing high area, and also last week high area as well. Last week high at 132.15. All right, so this will be the important level to watch. So if we start to see a bullish breakout above 132.15, then that will potentially validate a minor bullish double bottom formation over here. So this is a potential double bottom. All right, over here, double bottom. Right, so if we start to see a clear bullish breakout, an hourly close above 132.15, then that would validate a potential much more minor recovery scenario, potentially to expose the next resistance level at 132.50, followed by 133 figure level, which confluence with the key 200-day moving average and the 50-day moving average. So that's for the euro dollar. That's for the sterling pound. The sterling dollar still maintaining that bearish bias below 131.40 for a potential residual push down to test the key near-term support level at 130.15, 1.2990. Upwards next will be the Asia Pacific currency. The Aussie dollar continues to trade within our neutrality zone. So on last Friday, it managed to survive at our medium-term pivotal support level, which is my lower limit of the neutrality zone at 160.40, 160.30. Why this support level is important? Because that's confluence with the lower limit of this expanding wedge configuration that has been in play since the low of April. All right, April 2025, 24th of April 2025. All right, so it has been this very important as expanding wedge range support level. So still no change, still neutral between these two levels, between 64.40, 64.30. Upper limit will be 64.60 slash 64.67 over here, as it managed to as last today Asia session failed to have a proper surpass above this level, and this level 64.67. Right, let me put it away. 64.67. Also confluence with the 20-day move. It also confluence with the 20-day moving average. So only a bullish breakout above 64.67, then that will potentially validate a intraday potential push up to retest the next intermediate resistance level for today at 64.90. Right, so neutral for now for the Aussie dollar between 64.67, lower limit 64.40, 64.30, which is our medium-term pivotal support level. Okay, up next will be the dollar yen over here. So dollar yen on last Friday, we do have a very tight short-term pivotal support level for 5680 for that potential residual push up over here. All right, so on Friday, it didn't shape that residual push up, and instead it drifted down lower and broke below our tightened short-term pivotal support level at 5680 level. So with that, potentially now we may now see some form of short-term weakness coming into the dollar yen, and we start to see that the dollar yen also now shape a drop below the 50-day, the 50 level mark. All right, over here. So if you look at the hourly RSI, it also shaped that bearish breakdown from this previous parallel ascending trend line, and now it managed to did a bearish reaction of the 50 level mark as well, indicating downside intraday momentum on the dollar yen. And on the dollar yen, if you look at the daily time frame chart, so still remember that why we do have that bearish we call it that cautious, not say that cautious push up, because late last week, it did a steep rally, and this steep rally is coming very close to the medium-term pivotal resistance zone of 1583, 1580. And on Friday, it formed a bearish evening star formation by taking into account of these three candlesticks on Wednesday, Thursday, and Friday. So this bearish reversal, three-day bearish reversal candlestick, we call it a bearish evening star, right below a medium-term pivotal resistance level at 1583, 1580. And also the RSI also managed to hit close to more than 12 months of a most overbought level since 3rd of July 2024 at 76.2. So on Thursday, it formed a RSI level of 75.14. So that is the most overbought since 3rd of July 2024. All right, so that being said, in the short term, there could be some form of minor mean reversion decline that could take shape on the dollar yen, at least in the short term intraday basis. So with that, two key resistance level to watch for today as we flip our bias to this bearish bias for this minor mean reversion decline scenario to take shape, at least in the first step for the dollar yen. Two key resistance level to watch for today. The intermediate resistance will be at 157.13, followed by the short-term pivotal resistance level at 1580/158.35. Short-term support level to watch 155.95. A breakdown below it exposes last Wednesday minus swing low at 155.25 next over here. And if we do the Fibo retracement of this last minor impulsive up move from the low of 29th of April all the way up to last Thursday intraday high, the 155.25 also confluence with the 38.2% Fibo retracement as well. Right, only a bullish breakout above 15835 may see a probe at the upper limit of the medium-term pivotal resistance zone, which is at 158.80. So that's for the dollar yen, flipping to a bearish bias for a potential minor mean reversion rebound below 158 figure level, 15835 short-term pivotal resistance. So right, so that sum up the intraday technical outlook on the major US dollar pair, four of them. So let us now move our attention to the major stock indices, starting with the Hong Kong 33 that is representing the Hang Seng Index. So Hong Kong 33 managed to do a push up in line with the major US stock indices. Now it's actually testing our pivotal resistance level that we highlighted on last Friday, which is 25,535. So still using 25,535 as our short-term pivotal resistance level, still maintain that potential bearish bias that may take shape on the Hong Kong 33. So if you look at the Fibo retracement of that sell-off that has taken shape on last Thursday all the way down to Friday US session high, it has already hit the golden ratio retracement of 61.8%. All right, over here. So still using that 25,535 as our short-term pivotal resistance level, maintain that bearish bias on the Hong Kong 33 that's representing the Hang Seng Index. First resistance level to watch out for will be last Friday Asia session low, 25,150 level. All right, 25,150 level. Okay, a breakdown below 25,150 exposes the next near-term support level at 24,920, which is the minor swing low of 13th of October. Only a bullish breakout above 25,535 will see a potential squeeze up towards 25,760, followed by 26,045 next. So that's for the Hong Kong 33. Next up will be the Japan 225 that's representing the Nikkei 225. So Japan 225 managed to survive at the 50-day moving average and managed to bounce up higher in light with that positive news flow coming out from Japan, which is the approval of that larger additional budget stimulus by the new administration. All right, so it still managed to survive at this medium-term pivotal support level at 48,450. So we have a neutrality stance on last Friday, and so given the fact that there will be lower liquidity coming into the Japanese stock market today, why? Because the cash Japanese stock market is closed for a public holiday today. So with that lower liquidity, we will have a neutrality stance. So neutral between 48,450 and this upper limit will be at 50,250, 50,730, which is the 20-day moving average as well. over here. So still remains a neutrality stance on the Japan 225. Yes, it still remains on support, but given the lower liquidity today due to the closure of the cash Japanese stock market for a public holiday in Japan today. Now, great. So next up will be the Germany 30 that's representing the German DAX. So the Germany 30 also managed to squeeze up and now testing the upper limit of this descending channel that I drew from the minor swing high of 13th of November, and also exactly at our short-term pivotal resistance that we highlighted on last Friday, 23,300 level. So still watching the 23,300 level as my short-term pivotal resistance level, still maintaining that bearish bias, but two key resistance level to watch out for today will be at 23,080, followed by last Friday Asia session low at 22,935. Okay, so let me put it in writing. 23,080 followed by 22,935. All right, so these are the two near-term support level to watch. Only a bullish breakout above 23,300 will see a squeeze up to test the next intermediate resistance level at 23,450, which confluence with a key intersection of the 200-day moving average and as well as the former trend line, ascending trend line support that has been taken down on last Tuesday from the previous swing low of 19th of June. Right, only a bullish breakout above 23,450 that will potentially signal a more pronounced mean reversion rebound scenario towards 23,665, followed by 23,960, which confluence closely with the 50-day moving average as well as the 20-day moving average as well. Okay. Onward next will be the major US stock indices, starting with the US Wall Street 30 that's representing the Dow Jones Industrial Average. So the US Wall Street 30 rebound managed to store around our short-term pivotal resistance zone at this 46,335, access 46,575, which confluence very closely with the 50-day moving average. So as long as this level is not surpassed to the upside, we'll still maintain our bearish bias for a potential minor drop for today's session. First support level to watch 46,010. A breakdown below it will retest last Friday's swing low at 45,760. Only a bullish breakout above 46,575 access short-term pivotal resistance level will invalidate the bearish bias to see a squeeze up to revisit 46,965, maximum 47,340, which confirms very closely with the 20-day moving average. So 46,950 will be the pullback resistance of this former minor ascending channel support from the low of 13th of October this year, now turns into a pullback resistance. So that's for the US Wall Street 30. Watching closely this pivotal resistance zone for today at 46,355 / 46,575. Next up will be the SPX 500. So the SPX 500 also drifted into this access level as well. Let me slash it. 6,675. Right over here. So this is the access level. So it also drifted up into this level as well, this zone. So I'll be watching this zone very closely for today. 6,635 / 6,675. So if you do the Fibo retracement of that previous sell-off that's taken shape from Thursday, induced by NVIDIA exposed earnings evaporation of their earlier share price gain, that also confluence with the 50% and the 61.8% Fibo retracement. So maintain that bearish bias, but we first support level to watch out for will be at 6,670. A breakdown below 6,570 will increase the bearish bias to retest last Thursday and last Friday minor swing low area at 6,540. However, a bearish push up above 6,675 access short-term pivotal resistance level for today will see a potential squeeze up towards 6,720, followed by 6,780, which confluence with the 20-day moving average. Lastly will be the Nasdaq 100. So the Nasdaq 100 also managed to squeeze up and rest at exactly at the short-term pivotal resistance zone that we highlighted, 24,390, 24,580. So still maintaining that bearish bias over here for today. So two key support level to watch out for in near term. In the first step will be at this 24,170 24,170. A breakdown below 24,170 were exposed last Thursday and last Friday minor swing low area at 24,000. Only a bullish breakout above 24,580 will invalidate today's bearish bias to see a further squeeze up towards 24,940, the 50-day moving average, followed by the 20-day moving average that is confluencing with the minor swing high of 17th of November at 25,290. So that's for the Nasdaq 100. Continue to watch this short-term pivotal resistance zone at 24,390, 24,580 to maintain that near-term bearish biasness on it. All right, so that sum up all the intraday technical outlook on the major stock indices. Let us now proceed with the commodities market, starting with the gold XAU/USD. So gold XAU/USD remains lackluster. Deep down, hit our first support level for today at 4,038. RSI continue to shape a lower high below this parallel descending trend line, indicating the lack of upside momentum. So still no change, still using the pivotal resistance zone 4,110, 4,133 level or zone to maintain that bearish bias. Only a breakdown below 4,038 will increase the intraday weakness to expose the next near-term support level at 3,980, which confluence very closely with the psychological level of 4,000, which also coincide with the 50-day moving average as well. Only a bullish breakout above 4,133 will invalidate today's bearish bias to see a squeeze up to revisit 4,155, followed by 4,203 next. So that's for gold XAU/USD, still maintaining that bearish bias with two key support level to watch. With one key support level to watch in the near term, which is the 4,038, should be confluence with the 20-day moving average. A breakdown below it increase the probability of a further drop in near term towards the next support level at 3,980, which confluence with the 50-day moving average. And the pivotal resistance zone remains the same at 4,110, 4,133. All right, so that's for gold XAU/USD. Lastly will be the West Texas crude oil. So the West Texas crude oil continues to drop as expected, hit our first support level at 47.90 before trading sideways in the US session over here. So with that, I'll be still using the first resistance, pivotal resistance level. The short-term pivotal resistance level will be at 59.32. First resistance level to watch will be the bearish reaction on Friday US session at 58.66 level. All right, so 58.66, maximum 59.32. So still maintaining that bearish bias as long as price action didn't surpass 59.32, short-term pivotal resistance on West Texas crude oil. Near-term support level to watch for today will be last Friday minor swing low at 57.54. Right, 57.54. So 57 point, what's this level again? Yeah, 57.54. Let me put it in writing. Okay, 57.54. So a breakdown below 57.54 potentially will see a further weakness to test the next intermediate support level at 56.80, which is the minor swing low of 17th of October and 21st of October, which is also the lower limit of this ongoing minor sideways range configuration that has taken shape from the low of 17th of October. And previously, the bulls got rejected at the 50-day moving average at around the 63 figure level. All right, only a bullish breakout above 59.32, that's our short-term pivotal resistance for today, will negate the bearish bias to see a squeeze up to retest 60.40, which is the 20-day moving average. Above it may see 61.30/61.70 coming in next, which is the 50-day moving average. All right, so the 20-day and the 50-day moving average may act as a next near-term resistance level to watch in any case where the price action managed to break out above 59.32 short-term pivotal resistance that we have for today for West Texas oil, as we maintain the bearish bias on it. So with that, that sum up the intraday technical outlook on all the major cross asset classes. So before we go, let's have a quick look at the economic calendar on what are the key data to look out for today. So let me immediately go back to the calendar, refresh it for this week data. All right, so for this week data, not much interesting on the European session. Before the start of it, for those who have interest in the dollar Sing, the Sing dollar crosses, and as well as the Singapore 30 CFD index, we do have Singapore core inflation rate coming in at 1 p.m. Singapore time today. So 0.4%, a rather low number. and market, trading economic is expect a uptick to 0.6% year-on-year for the month of October. So for Singapore, inflation rate has been trending downwards. All right. So for at 5 p.m. Singapore time, we have business confidence data. They call it the I4 business climate data for Germany for the month of November. That will be out at 5 p.m. Singapore time, pardon me, 5 p.m. Singapore time. Previously, it's at 88.4. Market expectation, a slight uptick only to 88.5. So that could potentially, if you look at the trend of the business confidence data in Germany, it continues to improve since the third quarter of this year. All right, so market is expecting almost the same level, 88.5, as the month of October. So this is for the month of November. That will be released in at 5 p.m. Singapore time. So that could influence the euro dollar, the euro crosses, and the euro and the Germany 30 CFD index, especially on the euro crosses. So if the business climate continues to improve more than expected, let's say at 89 to 90 level, that could further reduce the odds of further interest rate cuts. So likely 3 meetings ago, that will be the end of the ECB interest rate cut cycle for this year, and that could offer some support on the euro dollar, given that the euro dollar, I share with you, is coming very close to a near term potential minor double bottom support, right, which I highlighted earlier on the intraday technical outlook on the euro dollar. So something to look out for at 5 p.m. Singapore time today. And going up next will be at 10:45 p.m. We have ECB President Lagarde public speech, so that could also influence the euro dollar and the euro crosses as well. So that should sum up. No key US economic data for today, and no Federal Reserve official speaking as well over here. All right, so that sum up today's Daily Dose of Market Insight. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.